Hello everyone, I am Dr. A. Nagalakshmi, Assistant Professor, Department of Commerce with Finance in Dr. SNSINSTITUTIONS College of Arts and Science, Coimbatore. I am here to explain a concept, final accounts of company, under the course Corporate Accounting. Now we shall go in depth to the content. Now we are going to see the preparation of statutory report. The word statutory itself gives an idea that it is compulsory, mandatory. We shall see the meaning of it. A statutory report is a mandatory report prepared by a public company limited by shares under the Companies Act and submitted to shareholders before holding the statutory meeting. So, statutory meeting, when a company is newly started, the first meeting to be conducted by the company after getting the certificate of incorporation is a statutory meeting. So, before holding the statutory meeting, it is compulsory to submit a report and it will be prepared by a public company limited by the shares and it is submitted to the shareholders. Now we can see what is the objective. To inform the shareholders about the financial position and the progress of the company from incorporation up to the date of statutory meeting. So, the main objective to prepare the statutory report is to inform the shareholders. So, shareholders are the sole, that is the main stakeholders of the company. Here, the financial position and the progress of the company from the date of incorporation till the date of statutory meeting is to be properly informed to the shareholders. This is the main objective. What are the contents? Content is as per Companies Act 2013. There are some that is what are the things which should be included in the report is the total shares allotted and cash received. Receipts and payments, that is preliminary expenses, underwriting commission, etc. Then particulars of contract requiring shareholder approval. List of directors, auditors, company secretary, etc. Arrears on calls from directors or managers. Next is preliminary expenses and discounts allowed. These are the contents which are to be included in the statutory report. So, how many shares were issued, how many were allotted, and how much cash is received. So, receipts and payments. So, many expenses will be incurred in the process. So, what are the expenses incurred? That is preliminary expenses, etc. Underwriting commission for underwriting the shares. So, those things has to be mentioned. Particulars of contract requiring shareholders approval. So, some contracts to be entered by the company with the outsiders. Here, the approval from the shareholders is mandatory. So, those things has to be included. Then, who are all the directors? Who are the auditors? Who are the company secretary? Those details has to be mentioned in the statutory report. Then arrears on calls from directors or managers. It is mandatory that, and it is an eligibility that a person who is going to be a director of the company, he should hold certain number of shares as per Companies Act 2013. So, if any amount is due, that is any arrear on call is due from the directors or managers, that should be mentioned. Preliminary expenses and discounts allowed. So, these informations are the contents of statutory report as per the Companies Act 2013. Then filing and authentication. So, must be certified at least 2 directors, including managing director. So, this report is to be certified by at least 2 directors. One will be the managing director. A copy must be sent to every shareholder and filed with the registrar of company. So, what the report containing all these things has to be sent to the each and every shareholders, and a copy has to be filed with the registrar of companies. as per Companies Act 2013. Now we are going to see what is meant by depreciation. So first one what we saw is the preparation of statutory report. Now we have to see the depreciation. We know what is meant by depreciation. Depreciation is nothing but a decrease in the value of the asset. We can see what is the depreciation in detail. Depreciation is the permanent, gradual reduction in the value of fixed assets due to wear and tear, passage of time, obsolescence, or usage. So, when an asset is there, that asset when we keep on using, so the value of the asset will get decreased. The performance of the asset will also decrease. Over a long time, the value of the asset will decrease. When the technology is outdated, the value of the asset will get decreased. Due to usage, it will be decreased. So, depreciation is nothing but the permanent, gradual reduction in the value of fixed assets. So, what is the objective? The objective is to ascertain true profit or loss. So, what is the true profit or loss of the asset? To present true and fair financial position. So, if we say, for example, if we buy an asset 10 years ago and if we don't show any depreciation, for example, if that asset was purchased for 10 lakhs 10 years before and we are not showing any calculation for depreciation, now after 10 years when we make the preparation of balance sheet, we will show the asset as 10 lakhs itself. For example, it may be a machinery or it may be a vehicle. Whether if we sell that asset, whether we get 10 lakhs, what amount we spent on purchase? No, because due to wear and tear or passage of time or obsolescence or usage, the value of the asset will be decreased. The performance of the asset will be decreased. So we cannot estimate or we cannot get the same amount when we make a sale of the asset when we purchase. Okay, so next is to provide funds for replacement of asset to comply with accounting standards and laws. So these are the 4 objectives of depreciation. Now we can see the method of depreciation. So we have straight line method. Straight line method is a common method followed by all the companies for depreciation calculation. So it is that is the amount of depreciation will be same for all the years. So now we can see what is the formula to calculate depreciation. So depreciation is equal to cost of the asset minus scrap value divided by life of the asset. So this is the calculation, this is the formula to calculate this depreciation under straight line method. Now we can go for the next method, that is written down value method. So here written down value method is the first fixed percentage on the book value each year. So other methods are unit of production, sum of the year's digits, machine hour rate, etc. So we have various methods. Even we have sinking fund method, labor rate method, etc. We have lots of methods depending upon the asset. Now we can see the provisions versus reserve for depreciation. There is some small difference between provisions and reserve. But in general term, we can, if we see, provision is also allocation of some amount for future. Reserve is also as allocation of some amount from the profit for that is for meeting contingency situations. Now we can see provision is the actual charge and P&L account. It is compulsory. Reserve is appropriation of profit. It is voluntary. If needed, we can have a reserve. But it is not compulsory. Legal requirement is Companies Act makes charging depreciation mandatory before dividend declaration. So what is the legal requirement for depreciation means company should make the charge of depreciation as mandatory thing before declaring the dividends to the shareholders. Next, what we are going to see is provision for taxation. Provision means keeping, that is allotting some amount, that is taking some amount from the profit and keeping it separately for some purpose. So, and we can say the meaning of it: an amount set aside from current profit to meet future tax liability is said to be provision for taxation. So, there is an accounting treatment. Provision for taxation is treated as a liability. Shown in the profit and loss, appropriation account and balance sheet under current liabilities. We can see the journal entry. At the time of creation of that provision, profit and loss account data to provision for tax account. When tax is paid, provision for tax account data to bank account. From the provision only, the company will make the payment of the tax. So, what is the importance of it? Ensure accurate profit calculation, prevents overstatement of profit. See, if the company has to know what is the actual profit earned by the company this current year. So, if we make this provision calculation as well as the depreciation calculation only, we know what is the actual profit calculation and accurate profit calculation. Next is disposal of profit. So disposal means, what is disposal? Selling, clearing. So now we can see the meaning. Distribution of net profit after tax and depreciation between dividends, reserves and retained earnings is said to be disposal of profit. Disposal means giving the profit after the calculation of tax and depreciation between dividends, reserves and retained earnings. So there are some steps involved in disposal. What are the steps? First, transfer to reserves as per Companies Act requirement. Next, payment of dividends. So dividends has to be paid. It may be a final dividend declared at annual general meeting or interim dividend declared during the year. The third one is allocation to bonus shares, CSR, corporate, that is corporate social responsibility expenditures or general reserve. Next, balance transfer to surplus or retained earnings. So how the profit is disposed, that has a steps. First, the amount has to be transferred to, that is from the where profit amount has to be transferred to reserve as per Companies Act requirement. Next, payments of dividend. It may be an interim dividend or it may be a final dividend. Next, allocation of amount to bonus shares, CSR expenditure or general reserve. If anything is kept, that is if any amount is we have as a balance, we can have make it as a surplus, that is we can think it as a surplus and we can have it in the retained earnings. So there are legal provisions for disposal of profit, that is dividend can be declared only out of current year profit or past accumulated profits after providing for depreciation. So it is mandatory to make the calculation, that is of depreciation, and it is to be charged and it has to be taken out from the profit. And it must comply with the Companies Act 2013 and SEBI guidelines. I think you have gained some knowledge about the financial accounts of the company in the various aspects like preparation of statutory report, then depreciation, charging of depreciation, methods of depreciation, then about the provision for taxation, and the last one is disposal of profit. Thank you so much for the patience listening.